Hello, everybody. At this time, we are talking about risks. In finance, risk is the probability that actual result will differ from expected results. In the capital asset pricing model, or CAPM, risk is defined as the volatility of returns. Concept of risk and return is the riskier assets should have higher expected returns to compensate investors for the higher volatility and increased risk. And then, what is the difference between a risk and a hazard? We start from hazard. A hazard can be defined as a dangerous process, phenomenon, substance, activity, or condition that may cause loss of life, injury, or other health impacts, properly damage, loss of livelihoods and services, social and economic disruption, or environmental damage. And a risk, on the other hand, the potential for consequences where something of value is at stake and where the outcome is uncertain, recognizing the diversity of values. Risk sometimes is represented quantitatively as probability of occurrence of hazardous events multiplied by impacts. If these events occur, risk results from the direction of hazards and a vulnerable asset or system. And then more risk in investing. In investing, risk is measured by the standard deviation equation, and logically, it makes sense. The equation measures how volatile the stock is compared to its average price. The higher the standard deviation, the higher the risk for a stock or security, and the higher the expected returns should be considered for taking on that risk. Low risk stocks tend to have fewer swings in price and therefore more modest returns on investment. However, high risk stocks typically swing dramatically in price and can often see huge returns. However, because they are more risky, the investor is taking more of chance that the return on their investment won't be what they expect. A major concept that comes into play evaluating risk in your portfolio is your time horizon. Essentially, a time horizon is how long you are able to keep your money in the market on the individual stock. If you have a long time horizon, you can generally invest in higher risk stocks, especially because you have more time to write out any dips in the market. And then we move to categories of risk. The first category, strategic risk. Strategic strategic risks affect the long-term direction of an organization. They arise from wrong decisions or unexpected developments in the market, like changes in the competitive environment, and then reputational risk and technological disruption. And then second, political and social risks. These risks arise from political decisions or social developments like trade wars or economic sanctions, charge of government with new economic or regulatory parameters, and social unrest or threats. And then third, operational risks. Operational risks arise from internal processes, systems, or human error like IT failures and cyber attacks, employee turnover, wrong decisions in day-to-day business, and production errors or supply chain problems. And then fourth, environmental and natural disasters risk. There is often uncomfortable but can have a huge impact, like earthquakes, environmental pollution, and regulatory changes, and climate change and its consequences. And then fifth, financial risks. These risks affect the financial stability of companies or individuals, like currency risk, credit risk, and liquidity risks. And then sixth, project and development risks. These relate to specific projects and their implementation, like delays due to planning errors or lack of resources, non-compliance with quality requirements, and cost overruns due to incorrect calculations. And then seven, technical risks. These risks arise from the use of technologies, machines, or software like malfunction machines or software errors, failed innovation, and security breach in IT systems. And then eight, legal and regulatory risks. These arise from changing laws, regulation, or contracts, like new data protection laws, contract risks due to unclear and stricter environmental regulation or tax rules. And then we move to the components of risks. Threats are the type of events which could negatively affect our objectives. Threats are often grouped together in categories for simplicity, like environment safety, and then infrastructure, as the same functional team will have the threats, making management of the process easier. The second component of a risk is vulnerability, or describing the condition that allow an event to occur or those that might prevent it. Vulnerabilities exist due to the proximity to threat because of inadequate preventive measures or where there are poor or non-existent controls. Conversely, robust controls or separation from a threat will lower vulnerability. Vulnerability relate to both physical and non-physical threats. So both poor physical security and weak corporate governance create vulnerabilities. And then how do professionals assess risks? The first, risk assessment. It is a process that identifies potential hazards and assesses what may happen in case a hazard occurs. Using business impact analysis, the potential impacts are determined that may occur due to integration of critical business processes. And then second, risk analysis. It is the process of identifying and analyzing any potential future events that can adversely impact any company. The company performs risk analysis for understanding what might occur as well as the financial implication of an event. In this process, the steps taken to mitigate and eliminate the risks are also assessed. I think it is enough. Thanks for watching.